Now, our next guest is recommending buying Irish bonds. Elga Bartsch is chief European economist at Morgan Stanley in London. She's bullish on longer-dated government debt. Why? In her opinion, last week's bank stress test results were credible and, quote, likely to increase the focus on Ireland's positive economic trajectory. She also says the government's sovereign debt burden will stabilise at around 120% of GDP by 2013 and then decline. Well, Elga Bartsch now joins us. Now, Elga, good morning. Thank you very much for joining us.
Good morning.
Buy Irish bonds. Can you just explain your thinking a little bit more?
Yes, of course. So we think you should really acknowledge that Ireland is very different from the other peripheral economies in the sense that it is highly competitive. It has already gone through a very rapid and harsh adjustment process. So it's much closer, if you would like, to the end of the tunnel in terms of adjustments in house prices and other important variables. And more importantly, it is much more flexible to adjust. And we have therefore seen a very sharp shrinking in economic activity and the size of the construction sector. And of course, all of these adjustments have left sort of deep marks on bank balance sheets and the sovereign balance sheet. But I think now it's time to look ahead and to sort of acknowledge that this is a country that has a very competitive international position, a country that delivers a trade balance surplus of around 20% of GDP each year. And in this respect is very different from the periphery.
And Ireland, you point out, has in its history managed to manage a major turnaround in fiscal policy, unlike other peripheral countries.
Indeed, in the early 80s, Ireland was one of the most indebted countries in Europe, and they have since then, until a couple of years ago, sort of have become the least indebted country in Europe. So that was really a very impressive turnaround that was also due to some harsh measures that were taken by the Irish government in the 1980s.
What's the preferred trade then right now, Elga, when we look at the bond market? I mean, which specific trade should we be entering?
Yeah, the specific trade that we are recommending in our report is to buy the 25-year bonds because we feel that actually in the long end, these bonds are roughly trading around 70 cents at the moment. You sort of have the best risk-reward profile.
The other big news today, of course, Elga, is the downgrade of Portugal debt by Moody's. I suppose the same logic doesn't apply. Should we be going near Portugal debt right now?
I think Portugal is more difficult, partially because Portugal hasn't yet applied for external assistance. And at the moment, in the run-up to the elections in early June, it's in a bit of a political limbo. So it's a very different situation politically and economically from where Ireland is.
How soon before it asks for some sort of bailout? There are reports today there could be some sort of temporary loan facility from various EU governments. I mean, what do you expect to happen over the next few weeks?
Yeah, it's all a little bit up in the air at the moment because obviously as far as the EU and the IMF are concerned, I think ideally they would like to negotiate a full-blown adjustment program with a government that has a strong political mandate, like the Greek government, for instance. And so the question is whether you actually need to find a bridge until we have a new government in place that actually then has a mandate to negotiate with European and international authorities.
Elga, thanks a lot. Elga Bartsch, their chief European economist at Morgan Stanley & Co. International.